please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We are waiting for the consumer price index numbers. The CPI for the month of April is what we are awaiting. Our poll threw up a number of 4.45%, and that's come 4.58. So this is practically no surprise CPI, you'll have to say. Okay, it's about 13 basis points higher. After looking at the wholesale price index, there were some people who were saying it would come north of 4.5%. Until then, everybody was telling us it would come below 4.5, maybe 4.45. But now we did get a couple of people telling us about 4.5. So this is slightly higher than what the street is expecting. So I can't say it's a no surprises. It is a mild negative surprise. And you saw the bond yields already end at 7.82. Now that's fairly steep. That's factoring in a rate hike, you will have to say. And now we are getting more numbers. The food inflation numbers also coming in. But it's the overall CPI number that's flashing for you now on the screen, which has clearly come in much higher than what the street was expecting. The food inflation number has come in at 2.8%. Higher than the March inflation. Okay, it's pretty much similar to what it was in March, 2.8, and of course, a year ago it was much lower. So this doesn't look so much like a food-driven inflation. It looks like there has been some core element as well, and that's what the market feared. You know, even in the month of March, core inflation had already jumped to 5.37. By core, I mean you remove food and you remove fuel, then what remains? Largely services. That inflation could come in higher was what the market feared. So just to revise the number, 4.58 is the overall April inflation. The market was prepared for 4.45. So to that extent, 4.58 or nearly 4.6% would come in as a bit of a shock, especially because it's about 30 basis points above what it was in the previous month, which is March. Food inflation has come in largely in the same level that it was in March. I can now read out the other numbers for you. Our guests are joining us. Indranil Pan, the Chief Economist at IDFC Bank, Upasana Bharadwaj of Kotak Mahindra Bank, and Soumykanti Ghosh, the Chief Economic Advisor of State Bank, are all with us. Gentlemen and lady, I'll just read out the numbers to you and then take your reactions. Cereals, 2.56%. Meat and fish 3.59, 3.6%, eggs 6.26%, milk and milk products 3.2, oils and fats 2.1, fruit 9.65, vegetables 7.3, pulses is still down -12, sugar and confectionery -4. Those two have been, of course, falling. Sugar in the last 6 months, pulses for the last 1 year. And then let me straight away go to food and beverages as a whole is 3%. And then let me come to clothing. Clothing is up 5.29. 1 minute. Clothing and footwear together is up 5.1. Footwear alone is 4.27. Then come the services, so what you call miscellaneous. Before that, housing has come up 8.5%. Okay, so that's still the last residual of the pay commission impact. Fuel and light is up 5.2%. Then come the services. Household services up 4.75. Recreation and amusement up 4.96. Education up 5.06. Personal care and effects up 4.96. So miscellaneous on the whole is up at 4.96. Clearly preparing the way for a higher core inflation. That's the picture. Let me get to my experts. Well, first up, what would be the core inflation, Soumya, from the numbers I've given you? Are we getting close to 6%?
Yes, I think you are absolutely dot on it. It's 5.92% the core has come in. So that's actually a jump of around 50 odd basis points since March number. Okay. So it's basically a core-driven inflation in the last couple of months. In fact, from January onwards, if you look into the number, around 70 basis points have been added to the overall year-on-year core CPI number. Rest, I think, are as per expectations because we are expecting around 4.5%. Okay. The only negative surprise is possibly the housing has come in a little higher than what we were expecting.
Yeah, at 8.5%, that is a bit of a shock. Soumya, I'm coming to you in 1 minute. Let me get to Indranil Pan and Upasana as well. Indranil, a core inflation of 5.92, that's the number the Reserve Bank tracks very closely. Do you think this will shift the needle enough to make Viral Acharya opt for withdrawal of accommodation, as he put it in the minutes?
I think the comparative probability, so to say, of a rate increase and removal of accommodation has increased, especially as compared to the last policy to today. The oil also has jumped up quite a bit, so has the currency. So the currency depreciation along with oil and metals is also likely to be leading to input cost pressures, which obviously has to be passed on to the end user. Therefore, the overall inflation atmosphere has suddenly taken a sharp sort of dimensional turn, so to say, and that obviously is likely to make the Reserve Bank of India more worried. So while I still don't factor in a June rate hike, I definitely probably factor one for August. That is because the RBI would possibly want to see through what are the changes that are being made by the government so far as the MSP is concerned, and what implication it therefore could have overall on food prices. So the point that I'm making is that core already is on the higher side and probably sticking at the higher level for the next few months. The food can also surprise, as have this in this month too, with fruits and vegetables on the higher side. The comforting factor obviously continues to be pulses. Add to it the MSP and there could be a sharp rise in the inflation.
Okay. Upasana, now what would be your estimate? Are we looking at the Reserve Bank increasing rates?
Yeah, Lata, I think, of course, the probability has increased significantly, and with the core inflation being closer to 6%, I don't see, much reason for Viral Acharya to really change his view. He had already kind of confirmed that he would be calling for a withdrawal of accommodation. So that definitely happens. The question is whether it's going to be 2 members or 3 or maybe 4.
Yes.
Now we are moving that side, and definitely I would tend to agree with Indranil that June rate hike we are not looking at yet. But yes, the probability of a rate hike in August has definitely increased, given that most of the upside risk are materializing. And with crude oil going the way it is, the pass-through is yet to happen completely in the CPI index. So clearly the probability is pretty high now.
Okay. Well, I'll come to the bond markets in a bit. What's the trajectory from here on? Taking off from where Upasana has left us, Soumya, what's the trajectory? MSP is yet to come. As Indranil pointed out, rupee is depreciated, crude has risen, and now, as Upasana points out, it's gotten passed on after the Karnataka elections. So what is the trajectory from here on? Do we see 5% shortly, and will the end of the year, March 2019 number be a lot higher than the Reserve Bank's trajectory of 4.4?
See, there are 2 things, Lata, over here. The first regarding the withdrawal of the accommodation, as the Deputy Governor suggested last year. Fortunately, there are 2 things playing over here. Yes, the June inflation numbers could actually track over 5% as our internal prognosis suggests. But I think even if we leave aside a June rate hike, when the August policy will take place, I think the peak will be reached by June. So in August, the RBI should be working with a June number. So if that is the consideration, their policy meeting could be a little bit hawkish. But as per our trend, I think after June, the inflation rates actually starts to decline. And it goes all the way till the end, till around December. Then again it starts rising. So it's difficult to say what will be a call by the central bank, because the July data will not be available when the August policy will be announced.
That is true.
But I think that the June number should see a peak.
Okay. No, Soumya, two questions before we get there.
Yes.
First, I'm asking you, what is your own trajectory? Where do you see inflation by September? The RBI had given a range of 4.5 to 5.1 for the first half and 4.4 average for the second half. What are your current numbers after seeing both rupee depreciation and crude rise, as well as today's numbers?
No, even if I look into all the numbers, our forecast for the second half still looks much lower than what the RBI projects. I think RBI projects an average of 4.4%. We are still lower than that.
Really?
In fact, in some of the numbers, we had repeated that November or December numbers could actually come closer to 4% or so. Yes. Oh. So I am still not too much bothered about the trajectory, even though I appreciate that the peak is yet to come.
Okay.
Because this number is actually lower than the market expectations.
Okay, then to the next question. It's not lower than our market expectation. Our market expectation was 4.45. I mean, in the sense our poll, and compared to that, we've got 4.58.
No, it is the RBI expectations.
Oh, okay.
The RBI.
Fair point. Their expectations were 4.5 to 5.
I'm talking about the RBI expectations.
No, fair point. Now, what I wanted to ask you, Soumya, is what happens in June? Now, June, whatever the RBI has to know for June is already now on the table. We already have, this is the last inflation number that they have to react to. And mind you, this is only, it was 5:1 in favor of pause. Even if Viral Acharya walks over, it will be 4-2. So is there a chance of a hike at all in June? Soumya.
No, I don't think a June rate hike should be, I mean, when the recovery, the numbers which came out on the IIP last month, you have seen, last week, you have seen the numbers, the growth is still at an incipient stage. So I'm not sure whether rate hike in June, even though the numbers could be 4-2 or even, I mean, in the worst case, it could be 3-3 with a decider vote by the governor. But as far as my understanding suggests, there should be a strike of note of caution. But a June rate hike or any action as of now looks a little bit distant.
But August is possible, you think?
But the numbers could look, I mean, the voting could actually tilt a little. I'm not saying it's possible, but because in August the numbers will start actually receding from June onwards. But the RBI will not have the numbers in June when the policy is announced.
Okay.
So that is going to be the major handicap for the RBI in August.
Okay. Well, I've got Abhishek Upadhyay of ISEC also with me, ISEC PD. Abhishek is one of those, ISEC PD is one of those few economists who were always calling for a rate hike in August. Confirms your fears, Abhishek?
Well, yes, Lata. So we retain our expectation of a August rate hike. This number is actually a little higher than where we thought it would be. So the CPI at 4.58 compares with our assumption of 4.5. And the internals are also not so good. So core inflation, you were seeing at 6%. And, you know, you got this trend despite veggie prices being lower this reading. We had thought that veggies would be flat. They're in fact down. So internals are not great. So yeah, reaffirms our bias of a August rate hike. In fact, June is I would say June is a live possibility as well. Not our base case. But if you look at markets are already fully priced in for a June rate hike, and in fact 2 rate hikes thereafter.
Now I'm coming to the market pricing in a minute. Let me just get all my economists on what is their inflation trajectory and their RBI forecast, and then I come to the markets. Indranil, your inflation trajectory here on and RBI action.
No. I guess RBI action, I had already pointed out that I am not really looking at June, and I would be looking more at an August. RBI action, I had already pointed out that I am not really looking at June, and I would be looking more at an August, where the probability has definitely got elevated with these inflation prints. From an inflation standpoint, I think the RBI's latest trajectory is likely to be exceeded in the first half of the year at least. Yes, the numbers might actually come down beyond that, but for the year as a whole, I think we are looking at a 4.5 to 4.6% average inflation, and that could remain worrying from the Reserve Bank's perspective, given that core inflation remains on the higher side. So I think these are the perspectives that the RBI would be watching out for. And as Soumya rightly pointed out, I am still not confident about how strongly we can talk about the economic recovery, given that oil prices have also bounced significantly on the higher side, which from a net trade angle should actually be a huge drag for the GDP. Plus, with the relative accommodation so far as interest rates and input costs turning around, we should not get a GDP which exceeds maybe 7 to 7.1% in any significant way.
Well, RBI's own calculation was that they have forecast 7.4% growth and this 5.1 and 4.4 inflation on the basis of a $68 crude. Now that we could be averaging 78, their own forecast would be 30 basis higher on inflation and 10 basis lower on growth. That's in the MPR. But Upasana, without coming to that, your inflation forecast, your RBI reading.
Yeah, Lata, actually, again, I think the upside in the first half, the inflation, probably 20 basis or 30 basis is what we expect inflation to be overshot from RBI's estimates. And the second half also we're expecting a range of about 4.1 to 4.8. Of course, it does right now suggest that we would be looking at a closer to 4.5% number around March 19. But having said that, we still do not have clarity on MSPs. We do not know how exactly the fiscal scenario is going to pan out. Crude impact and the pass-through that is yet to be incorporated fully, depending on how the full year average is going to be. So I think there are significant risks here. And hence, this 4.4 also probably is subject to upward revision as we go into the rest of the year. So clearly, 4.4 is, at this point in time, we are looking at by March 19. But this is subject to revision because most of the upside risks seem to be materializing.
But really at 4.4 and an overnight rate at 6, there isn't really a need for a rate hike, is there, Upasana? Are you factoring in a rate hike?
No, like I said, the probability has definitely increased, but I would still like to preserve my opinion because we are not really calling for a rate hike yet in the year. But like I said, the shift of stance and hence the probability in August has increased for sure.
Okay. Well, now let me come to what it really matters. Does a rate hike really matter or is it already in the price? Abhishek, 7.82 at the end of trading day today on the 10-year. And I'm not very sure about the other paper, but I remember seeing 7.44 on the 2-year and probably 7.68 on even the 3-year paper. I mean, the point is, already we are seeing a 7.5 average even from the 2 to 10-year period. So, is everything in the price? Is there anything left to move at all tomorrow?
Well, as you said, so we already saw quite a bit of sell-off today after the WPI numbers were released. The details there suggested that veggie prices would in fact be higher. Foods inflation, for instance, were also high. So there was a possibility that, you could see a higher CPI print and it got priced in. So I'll not say that, this CPI print should really be a surprise or should be a big driver tomorrow morning. But again, the point is that, if market is really worrying about a rate hike, as soon as June, whether there's any scope for a rally from here. Our hypothesis always has been that, bond markets price in, any potential rate moves much in advance. That has been the case so far. But yeah, so what markets will look for possibly, as Upasana said, MSP details are not yet out. That would be one important driver. OMOs, what is the pace at which possibly RBI carries out its OMO purchases will be another crucial near-term driver for markets. But yes, in the come policy, what we want to see is, what is the guidance RBI provides? What is the pace of rate hikes that could possibly be, happening over the course of the year? So those soft factors will be more important drivers rather than a rate hike itself.
Okay. Well, so what really happens from now to June 4th, is it? Yeah, I think the monetary policy is on 4th or 5th. What really happens till then? Do you see yields pretty much at current levels, Abhishek? Or do you think any of the yields, maybe in more near term, maybe T-bill rates move up?
Well, we've expected, the 10-year benchmark to trade in the 7.5–8% range. So we will stick to that. In the near term, there is hardly any downside possible, we would think. So it could still head a little higher. We don't discount that possibility. But yes, so the short end of the yield curve, in fact, has already priced in 4 rate hikes, as far as 4 rate hikes. If you look at, bond yields at, 2-year, 3-year points, they're already priced, for 3-4 rate hikes. Yeah. So if there is a move left, possibly it is at the intermediate and longer tenors rather than the short end of the yield curve.
Oh, so you can see the 10-year go to 8, is it?
Yeah,
I mean, like tomorrow, is it 7.9?
No, I don't want to say it will move tomorrow to 7.9, but if we get, for instance, if RBI does not carry out a OMO purchase as soon as announce an OMO purchase as soon as next week, then we would certainly see yields going higher. So soft and technical factors would be the more important bits driving the markets up until the policy.
Okay. What about CPs and bonds, Indranil? That's the price at which NBFCs will be raising money. Are we going to see that rise further? Anyway, what is the going rate for a 1-year CP and maybe even a 5-year NCD? Will all those start rising now?
Well, I think the overall reflection obviously will be the underlying curve. I broadly agree to the view that was just aired in terms of a 7.5 to 8%, and there could be bits of upticks over there. But I think a critical factor for the market would continue to be also the liquidity position that the RBI is likely to sort of infuse in a scenario where they are likely to sort of continue to interact in terms of or intervene in the FX markets. So I don't think there is any significant chance of a corporate bond yield at any maturity to actually come significantly lower from where it is right now. It, in my opinion, would be more a function of the overall market liquidity than maybe the repo rate structure of the Reserve Bank of India or the signaling by the Reserve Bank of India.
Well, all those markets are in a turmoil also because of those stock-wise limits that have come into play. So at the moment, there's more confusion than just on the interest rate view, I would assume. Soumya, generally, do you think banks will be now, moved into raising deposit rates and then lending rates?
See, Lata, two things. I think if you look into the data for all the banks from last 3 to 4 months, of around, if you take them around 20-25 banks, I think around 20 of them has raised the rates, and only 5 of them has actually cut the rates, but that was from very high levels. So in my sense, I think the rate action of the banks have now become completely diverse from the repo rate action, and that has been driven by the liquidity in the market, because core liquidity in the last week of April, when you saw it, was almost close to zero. So that's an indication of that's actually influencing the yield movements. And the other important statistical artifact which is likely to play up and confuse the matters even for the central bank is that in the next 2 to 3 months, you can actually get some very good IIP numbers, because remember that last year, this was the time when destocking was happening. Okay. So from that point of view, that could actually give you a very favorable base, and that could give us an impression that all is actually well in the real economic activity, which may not be the case.
Oh, right. That puts another parameter into the calculation. Of course, the March IIP was nothing to write home about. But gentlemen, thank you very much. You may want to listen into the stock market expert as well. Deven Choksi of KR Choksi Securities has joined us. Deven, the uniform opinion of all my economists, experts, is that you are going to see yields climb even further. Even today, the yield has ended at 7.82, and the retail inflation, while it has come in at 4.58, the core inflation, stripped of food and fuel, the eccentric matters, is actually ticking at 5.9, almost 6%. So the expectation now is that the Reserve Bank can move on a rate hike as early as August. Even if the Reserve Bank doesn't move, that's what the yield curve is pricing in. What would you do? How would you react as a stock market expert? Not touch the NBFCs or something like that?
No, Lata, I think in the near term, it is given that the rates are going to be firming up. I'm not having any doubt in my mind. But as the gentleman was saying, and I heard him saying that, the next big move, I think, is the higher amount of production coming in from industrial side. And higher industrial production would ultimately have the favorable impact on the pricing scenario. Remember, I think the monsoon is around the corner. The monsoon would probably have the positive impact on the food prices. Along with the higher amount of production will increase the supply side situation, and that will keep the prices under control as far as industrial product goes. So in the near term, though I don't rule out the possibility of yield forming up, eventually I feel that I think if you take the full year view, probably I think there are likely chances of inflation going up in hurry is not being seen. So market is definitely factoring that part of it. that yes, in near term we'll pay for the higher amount of interest costs eventually, but otherwise I think it will remain settled at respective levels, I think in the next 12 months' time.
It's not a food inflation. That was what the WPI told us. But what the CPI is telling us is that non-food, non-fuel inflation is rising. And this is without taking into account the depreciation of the rupee and the rise in crude prices, which will start hitting the inflation numbers in the coming months. Well, there is an optical possibility of IIP looking good because of the low base last year. There was destocking because of GST. But that apart, we are in for higher yields. That's the common message coming in from our economist. Well, the stock market expert is not so worried. We will wrap up this special coverage on the April consumer price index numbers with the news that it is somber. The news is that inflation is climbing, not just food, but non-food, non-fuel inflation. The core inflation number is the worrying number. And now there are increasing number of economists who are betting or expecting a rate hike from Reserve Bank in calendar 2018. We wind up this coverage, but stay on. More news and updates follow on CNBC TV 18.